If I think prices are escalating on me, I'm going to bring all those planned future purchases into the present. And that's why you get housing cycles. They're driven by people shifting their purchasing or selling decisions over time. And at some stage, we're going to get people going, I think time is on my side. There's a great number of new dwellings being built in Auckland, in other parts of the country. I think I'll just wait. And people will eventually shift their planned purchases back out 1 year, 3 years and 5 years.
Welcome to our second remote working COVID edition of Tea with Tony. At the time of filming, Auckland has today just moved out of lockdown into level 3. Meanwhile, Tony and I, who are based in Wellington and Queenstown respectively, are both gratefully in level 2. This month, the post-lockdown economic environment will be our focus. How are we tracking? Will there be another post-lockdown spending frenzy? Is inflation baked into our future? And surely the housing market has to have a reality check at some point. Hi, Tony, how are you?
Good, thanks, Lenska. Yes, certainly pleased for the Aucklanders there, but still a little bit concerned about some of those daily numbers. So hopefully some progress there fairly soon so they can join us in level 2.
So that's a really good place to start. Last month, we did a Teams version of this and, reasonably optimistic, felt like we'd been here before, but, you were confident of an economic bounce back. 4 weeks, 5 weeks later, what's your take?
Still definitely the same view. I mean, I see the commentary coming out of Australia, the Reserve Bank of Australia, OECD, etc., saying that while for the moment their economy will be weaker than anyone expected in Victoria and New South Wales, they're still fully confident of a strong bounce back on the other side when people are freed up. And I see no reason, to have a different view here in New Zealand, that obviously business activity has been heavily constrained in the short term because there's a lot of stuff we can't do, or you think you can do it, but at only 50 maximum for a while there in the hospitality sector. Well, then you're constrained. And even 100, I'm finding for functions I was going to do around the country, they can't physically spread out 100 people in a room, so, and get them in there. And so there is still a depressing impact on the economy, but I'm definitely confident that once we're freed up, I guess we're 90% vaccinated, we're going to see a fairly strong lift in most areas of economic activity.
You don't see it being anything different to what we've seen before?
Actually, it is different in that last time around, we didn't know what was going to happen. So most of us had a pretty negative view on everything, quite frankly. This time around, we know what happens in a lockdown. We know what happens, or at least happened last time coming out of the lockdown. So the level of consumer sentiment, it hasn't fallen away like before. Business confidence hasn't fallen away like before. And certainly when we're looking at our real estate, we haven't seen the same sort of falling away of activity. And I certainly don't expect to see a repeat of the first nationwide lockdown when average house prices around the country fell 3% over April and into May. I don't see prices falling at all anywhere at the moment. So in that regard, it's different, as in sort of less negative for the short term.
And look, is there any kind of guidance you would give to, I always think of small businesses in these situations, and we're actually a network, NZHL, of small businesses. And although we are in a very high performing industry, being that relating to the housing market at the moment, it's tough. It's, our business owners are probably more optimistic and positive than most, but in general, there's, if you're a florist, that kind of thing, any guidance to small business owners trying to kind of squeeze their way through in hospitality as well?
Well, maintain contact with your customers, because the customers definitely have goodwill towards you. Everybody is well aware of the difficulties being experienced by small, medium-sized business operators out there. So the best you can do is obviously try and move online where possible, do the takeaway situation, ordering through the apps where possible. But for some businesses, that still really isn't going to cut it. And certainly the Delta level 2 is nowhere near as good as the original level 2 alert of last year. So just where possible, maintain your presence out there and awareness in the minds of your customers, and hopefully they'll come back again with some extra sympathetic voices and open wallets when greater freedom is available. And the freedom is coming. one way or another, we are going to see an opening up of the economy, and hopefully it's going to be because we have high vaccination rates as opposed to just giving up and letting everything run riot, which is more the American way, it seems. I think we're fairly distant from that.
Yeah, and look, that brings us to spending patterns and inflation really nicely. It's something that we've been talking about as a core theme. So you see, are you expecting another post-lockdown spending frenzy, people buying spa pools, which is our favourite item to talk about?
Not so much this time around, because people have already got the spa pool. They've already organised the home renovations. I guess with summer coming along, okay, there's going to be some extra buying of kayaks, some recreational goods, etc. But in my weekly Tony's View publication, which will be out there and available, I think, before people get to see that, I've actually had a look at the retail spending numbers of the past year versus a year before. You can see increases for most areas of spending, but for some store types, it's far more than everything else. And so once we get, say, the borders open up, there's going to be greater weakness. If you're in a sector which has experienced a boom since the end of the first nationwide lockdown, you're not going to get a boom coming out of this lockdown, but your activity is still going to be strong. What's going to be a greater point of interest for yourselves will be 2022 into early 23, when the borders presumably are open. We Kiwis will be trying to spend our $10 billion per annum travelling overseas again. And so then I would expect to see quite a pullback in hardware store sales, recreational goods, eventually motor vehicles, furniture, appliances, home furnishings. Eventually there's sort of a payback. It's going to have to go back the other way. It's not going to be a disaster, because most of us are feeling richer because our house prices have gone up 37% since May last year. It's fairly ridiculous, but we feel wealthier. Yeah. There's good, strong labour market, so strong feelings of job security, and we've got at least another $10 billion extra sitting in our bank accounts at the moment, beyond what sort of should have been there without COVID-19. So I'm struggling to preach any sort of great negativity for most sectors, quite frankly, next year. That for me is a greater period of interest rather than the bounce from the lockdown.
And that brings us to inflation, and that is another thing we talk about a lot. It's, you talk about it in your columns, building materials, construction, freight. We are seeing that here at an everyday level. We're seeing big price hikes in building materials, baked in costs. Is that the new normal, and how's that going to affect inflation?
Yeah, well, basically just about everything I look at there is pointing towards inflation going up. If we just have a look at the past 2 to 3 months of things we have learnt, the inflation rate for the year to June, it wasn't 2.8% as most of us were thinking. It was 3.3%. Inflation is already above the target range. Wages growth has jumped on the measure I use from 2.7% to 3.4%, and that's much more than was expected. We thought maybe the unemployment rate fell to 4.4% in the June quarter. It's gone down to 4%. And the Reserve Bank estimated our economy grew by 0.6% during the June quarter. We grew 2.8%. The inflation indicators are just screaming red hot at the moment. And so people should fully expect that the Reserve Bank has to get these interest rates higher. But we've just seen some comments from the Assistant Reserve Bank Governor there indicating that the Reserve Bank is still going to move relatively cautiously, meaning I guess there's 0.25% increase in the cash rate coming on October 6, probably another quarter on November 24, probably another quarter on February 23. Now, that sounds good from a borrowing point of view, not so fast. The slower the pace at which interest rates go up, the less is the restraint on inflationary pressures in the economy. And we know from the experience of 2004 to 07, when the Reserve Bank eventually admitted they increased interest rates too slowly, you end up with interest rates going up for longer than you're thinking and going higher than you're thinking. And so that's why I'm saying to people, although most analysts are saying, you should allow for the cash rates going up maybe 1.5%. I would allow for 2.5% in my budgeting for the next couple of years, 2 to 3 years.
So what you're suggesting is you do think we will have an OCR increase in October, but it won't be as high as some people are predicting?
Yeah, that's right. Some of us were thinking maybe they would move 0.5% increase in either October or November. Now we're thinking, no, they're still going to take it relatively gradually. Now, in some regards, it almost doesn't matter what they do, not quite, but the markets have already factored in interest rates going up. And of course, lender interest rates have already gone up. You can't get the 2.99% 5-year fixed mortgage rate I was such a fan of, or for many lenders, it might have been 3.15%. Now you're looking at 1% higher. And just this past week, we've seen a range of lenders increase their interest rates again. So the interest rates are already rising out there. And having been in this business back in New Zealand since the mid-1980s, what I can say is that every single time we're at the start of an interest rate tightening cycle, we always say, don't worry, interest rates won't have to go up all that much. This time is different. Household debt is so much higher. People have got used to low interest rates. So, the Reserve Bank won't have to move that far. Well, based on that experience and hearing us all, most people say exactly the same thing now, it says to me the risk lies on the upside for inflation, for wages growth, and for interest rates as well. So that just means, chat with your mortgage advisor about this, but maybe have a look at a spread of the fixed terms there. Most people are looking around about 2, 3, 4-year fixed rates. Usually the 3-year term is where people are looking to get some reasonable hedging.
And look, that's what we're seeing, is that people are starting to come to us because we're a little bit different and say, I'm on a fixed income, or here's my situation. I've had some time to reflect over lockdown. How can I make the most of my mortgage and my situation? And there's usually a way you can do that. And we have structures and systems and personalised service to help with that. But that is the key point, is look at it now and look at how you can manage and get yourself ahead, because you can actually still get yourself ahead. It's just working with what you've got to do that, and paying attention, as I always say. Very, very interesting, because there's this, what you're saying, essentially, there's this, interest rates have to go up to stabilise inflation, just reminding everybody they're kind of negatively related. How do you say that, Tony? Are they correlated, interrelated, negatively related?
Inversely related, maybe.
Inversely related. That was the fancy economic word. It's probably not that fancy. I just couldn't remember it. So they're inversely related. And so you're either going to pay more for your lettuces and everything else, or your interest rates go up, so you're going to pay more for your mortgage. So there's no free lunch here, baby, is there?
Yeah, no. And because somebody's going to pick up on this, inversely related, interest rates go up and eventually inflation comes down, but initially inflation goes up and interest rates go up at the same time. So now we've got to introduce sort of intertemporal movements in there as well. Let's just say when inflation goes up, interest rates go high for a while, and then eventually they come back down again. But let me just give a warning. The level of uncertainty out there is the biggest I've ever seen in the monetary policy cycles I've been commenting on since the late 1980s. Don't ask me when interest rates are going to start coming down again. I have not got the foggiest idea. Neither does the Reserve Bank or any other forecaster out there. So yeah, just exercise a little bit of caution in that regard.
And here's another interesting one, because we talk about consents and how there's an equilibrium coming on the supply side a lot. And there's two views here. There's that we have a supply side issue, but we also have the greed issue. Any thoughts?
Well, for the moment, if we read greed as I've just got to get on the ladder because it's either it's easy money to make, that's present, but the greater one, which really drives the greater number of people to act, is if I don't buy now, I may never be able to buy. So in more calm times, I would be planning to buy my house 5 years' time, 3 years' time, 1 year time. But if I think prices are escalating on me, I'm going to bring all those planned future purchases into the present. And that's why you get housing cycles. They're driven by people shifting their purchasing or selling decisions over time. And at some stage, we're going to get people going, I think time is on my side. There's a great number of new dwellings being built in Auckland, in other parts of the country. I think I'll just wait. And people will eventually shift their planned purchases back out 1 year, 3 years and 5 years. We're nowhere near that happening as yet. We're not remotely near that, but that's what will start to happen over 2022. And at the same time that happens, the vendors who at the moment are going, I can't sell because I want to sell, but I won't be able to buy again. They'll be going, I think it's now safe to list the property, sell, and then look to buy. So the other side of the equation will change as well. So these things will happen. They've happened to previous cycles. I'm just guessing that's the story of maybe the middle second half of 2022. Best guess today.
Yeah, it's definitely reflecting in our business. In COVID, one of the previous lockdown last year, we saw just a drop in applications, as you would, and that uncertainty we were talking about earlier, whereas this time we saw a slight drop off, but then it just kept going. And so people are, it's that, well, I know what I know now, so and it's reflected in our loan applications and the work that we're doing with clients every day. And look, the other thing that I noticed in your notes, and something that we're seeing anecdotally as well, is Christchurch is hot to trot.
Yes, apparently I was on the front page of the Christchurch Press. My father called me up just an hour ago and said, Tony, you were on the front page of the paper. And he had to remind me what it was I'd said, because one does a number of interviews out there. Christchurch is New Zealand's second biggest city. And of course, a lot of people focus on Wellington as the capital, Auckland, obviously the biggest city, multicultural, etc. Christchurch is highly affordable. Your average house price is about half of what you're paying up in Auckland, and
good land availability.
Land is available. Christchurch has shown us post the 2/11 earthquake what can happen with section prices if you make a great quantity of land available. And this is one issue in the rest of the country. Local authorities don't have the land available because over the past 15 months, many people who in normal times would have just kept looking through listings for an existing property, they haven't found it, because the price has gone up and the listings have gone down. So they've shifted to getting something built. The builders, the property developers have soaked up the available sections. And so the supply of sections is relatively low, and that's pushed the prices through the roof. But yeah, down in Christchurch, actually, some of the section supply has dried up, but there's a lot more available property. Yeah. So I still remain quite positive in terms of some internal migration, population shift to Christchurch. And while I think there are some triggers in place at the moment, I do still think maybe it's not until the stadium gets built down there, a lot of people from the rest of the country visit for a rugby game or whatever and go, actually, why the heck aren't we here already? I think that is still yet to come along in greater force, but there are elements of it definitely for the moment.
Oh, I'm all for moving to the mainland. Look, we've got an extensive network of business owners in Christchurch, and a lot of them are telling me that we're seeing a record out-of-region inquiry based on affordability, lifestyle factors, particularly coming out of Auckland. So I don't blame people. I work remotely. It's an option, and but it is, and Christchurch has been undervalued on the back of the earthquake, which we've talked about extensively previously. So there is a little light in the tunnel, but particularly I think for first time buyers. If I'm to reflect on today's session, what I would say is it feels like a subtle shift, and I know you can't issue warnings, but a subtle shift and some concerning factors out there for people to be aware of. Would you phrase it that way, or are you going to correct me?
Yeah, no, the phraseology I've been using for sort of 3 months now, and I'm still strongly feeling this, is we are in the end game of the sharp increases in house prices over the past 1 year, the past 10 years, and the past 30 years. We're not at the point of the game ending and things settle back to a new normal. We're not there yet. There's still a few more months left of the frenzy. But for some people, maybe you do want to think seriously, how psychologically motivated am I to take a level of risk, which maybe is just starting to look a wee bit silly. It's hard to step back when everybody's saying to you, you've got to get on the ladder, you've got to get on the ladder. Cycles exist in the housing sector, and prices, sales, construction. So, we are going to see things slowing down, but we're not there yet. Okay, we're not there. There's going to be further action to try and accelerate the slowdown coming from the Reserve Bank and possibly again from the government, Treasury, Finance Minister's office next year. We'll see what happens there.
Okay, thanks, Tony. Look, thank you everyone for joining us this month. As usual, I'll just add my little disclaimer at the end. Tony is an independent economist. We like it that way. His views are his own and not necessarily those of NZHL and vice versa. Please do follow us on our social media channels where we post this. It's also available on our website if you need to look back. And Tony has his own publications that he does monthly and weekly as well. Thanks a lot, Tony.
Okay, thanks very much, Lenska. Ta-ra, everybody.